Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at 7 Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today we have an exciting episode. As a host of macro concerns continue to weigh on the global economy, the stock market has responded accordingly. The S&P 500 index is currently off 17% from its all-time highs earlier this year, and the Nasdaq Composite is down more than 30% from its highs. Some former market darlings have taken even harder hits and are down well more than 50% from their previous highs. In this episode, I am joined by my 7 Investing co-lead advisor, Anirban Mahanti, and Alex Morris, the creator of the TSOH Investment Research Service, to look at 7 such former high flyers. Gentlemen, how are you doing?
How's it going?
Doing good.
Thanks for having us.
Of course, yeah. Well, the market has been very gracious to give us a third opportunity to review our stocks that have been hammered accordingly. So, the market's like, and the market gods are listening. It's okay. We don't have to do a fourth show, but tonight, our goal in this episode will be to determine whether the companies we're looking at in this episode have been punished too severely by the market gods, or if they're due for a rebound, or if these stocks will never regain their former heights. In this episode, we'll be looking at Ally Financial, Domino's Pizza, ServiceNow, Five Below, Amazon.com, Tesla, and Netflix. This is our third record rebound episode. So if you like this format, look for our previous such episodes in our archive. Are we ready to begin, gentlemen?
Let's do it.
Let's do it.
All right. So, well, those are the indexes right now, as we can see. I think as anybody listening or watching on YouTube, if you're watching on YouTube, you can follow along. We're going to be sharing a lot of graphics and charts and images along the way. But if you're listening, we'll try to describe what we're showing. But like the indexes, as anyone listening knows, have been hammered this year. Our first stock we're going to look at, though, is Ally Financial. Ally Financial is down 44% this year, and from its highs in early January, it's probably down closer to 50%. Its market cap was once like about 18 billion. Now it's under 8 billion. Alex, is Ally Financial a wreck or a rebound?
Sure. So, well, once again, thanks for having me. I'm always happy to do these podcasts, and maybe one day we'll do it on, a bunch of stocks that are just up even. They don't have to be up a lot.
Up too high?
Just stocks that are up. But if we cut to the first chart, I think it does a really good job of laying out the story. And you see it in a lot of sectors, obviously, where you have COVID impacts, and in some cases it was a huge headwind and now it's a tailwind. In other cases, it was a huge tailwind, now it's a headwind. Ally is an interesting chart where, as you can see here, trailing 12-month earnings were running around $2, $3 as we came through 15, 16, 17, 18, 19. Then in 2021, you saw a massive step up with earnings reaching a high around, I believe it was $8.60 a share. And what really happened is this was a greatly fortuitous environment for Ally, given the nature of their credit book. And I believe it was the second quarter of 21. They had the lowest charge-offs in the history of the business, which dates back over 100 years. So used car prices were going through the roof, and naturally, when you're underwriting against used cars, if prices are going up, even if people are defaulting on the loans, you could actually be better off in some cases as a result of that. As you look to, what's coming up now, as we look to the fourth quarter of 22, for anybody who can see the chart, you can see that the trailing 12-month earnings are starting to come in pretty significantly, and it's pretty safe to assume that, the roughly $6 of trailing 12-month EPS that you see for the Q4 estimate will not be as low as it goes. There's more to fall, and there's a number of factors that are playing in here. One is the chart shown here, which is used car prices. Used car prices have started, after a significant run, have started to come in. The other really important factor is the Fed funds rate has started run higher and very quickly, which for, a bank like Ally, the timing of the repricing of the asset and liability sides of the balance sheet can pressure NIMs in the short term, especially when rates change a lot very quickly. On top of those two factors, this is a story that's had a lot of share repurchases driving, the per share numbers higher. And as a result of those two headwinds, you're going to see, really lightened activity, at least for the foreseeable future, probably through 2023. Next slide. Yeah, so this shows the charge-offs in the credit book. As I was saying a moment ago, saw truly fantastic results in 2021. By far the lowest that you've ever seen at the company, or at least in a very, very long time. As you look ahead to the next 2 years, or finishing out 22 and heading into 23, there's an expectation that we're going to revert to something that looks more normal. On top of just a reversion in the environment, it's worth calling out that there's been some loosening of the credit terms, most notably in terms of the tier that they're writing to, whether it's prime or subprime, and then also the length of the car loans. It hasn't been particularly significant, but you've seen it stretch out by a number of months in terms of average term. So management would argue that they believe that the risk-adjusted returns justify making this change, but when you incur incremental risk, obviously, when the environment goes against you, you're gonna have higher losses. It's worth noting here that, in my mind, as I look at the financials, I still think that Ally is very conservatively positioned in terms of reserves, and compared to other auto underwriters, I think they're quite a bit more conservative. Granted, it's probably appropriate given the nature of their book, but I don't think they're being aggressive in terms of how they think about the realized losses here. Next slide. Yeah, and this just shows the retail deposits per share. As I noted a moment ago, share buybacks have been pretty significant. The other important part of the story is that Ally has been taking a pretty significant deposit share over the past decade or so. And for me, that's really a major part of the investment thesis, which is there's a component of this story that kind of rhymes with Geico in a scenario where things go really well, where they just have a better mousetrap for attracting deposits and running the book basically more efficiently. So the market is on a basis of something like retail deposits per share. The market is valuing this company very differently than it was a few years ago, but time will tell whether or not that's appropriate.
Alex, do they break out? Like, I know they large part of their book is just making these auto loans, but if you don't have an auto loan with them, you might just think, like, when I see their advertisements, at least online, it's always for like these high yield savings accounts or something like that. Like, how much of their book is auto loans? Like, I know it's a huge part of it, and I know that's like a big part of it. Is that like the majority of their business though?
Yeah, in terms of the credit book, auto loans are the majority. And just for some history, Ally was basically spun out of GM coming out of the financial crisis. It was their auto lending arm. So this was a lot of, historically, it was, as far as I know, mostly new auto loans, but over time they've increased the mix, new. And over time they've increased the mix of used. To your point on the deposit side, I think that's 100% correct. And it speaks to some of the commentary on the call, where they were talking about more aggressive, offers for savings account rates that they're seeing in the market. And, it's an important reminder, as I wrote in my most recent update to subscribers, there is a component of this business in my mind that's a little bit different than how your average Wells Fargo or Bank of America customer is going to think about what they're getting paid on their deposit. This is someone who is price shopping isn't the only consideration for whether or not they're going to have an account with Ally, but I think it's a bigger factor than it is, again, for just your average US bank customer.
Yeah, absolutely. And it's all online, correct? They don't have like physical branches, right? Am I right there?
Yeah, correct. Yeah, it's an online bank.
And are the higher interest rates, like, how, like, for most banks, that's like a huge net positive, right? I mean, you have your net interest margins for banks, and they earn more money as interest rates go up. Like, it's the same dynamic at play though for Ally with like their huge car loan book?
Yeah, I mean, it all depends, right? It depends how that flushes through on both sides of the book. In theory, if you can keep your deposit betas, meaning as rates go up 100 basis points, 200 basis points, how much you have to take up deposit costs in order, to stay competitive. both sides of the book should reprice over time. And if deposit betas are only at 50% or something, you should see widening NIMs. As with almost everything in business and investing, it's hard to single out that one variable because it starts moving other things. So my short answer is we haven't had to test this theory yet on banks, which I've owned for a while, partly on the theory that NIMs would expand once rates actually normalize over a period of years. We may eventually see whether or not this is true, but I think it might be too early to truly know.
Sure. And the PE ratio, I mean, it's insanely low right now, right? But that's just on expectations that earnings are going to fall in the years ahead.
Yeah, I mean the numbers, when people were quoting it at the end of last year saying, hey, this thing has $8 of earnings and it's at $40 or whatever the number was, $30. That number was never really real. Right. I mean, the normalized number in my mind, I've been writing for at least the past 3 to 6 months. Hey, I think the number's probably in the $4, maybe the $5 range. So I think that's a more realistic way to think about it. And the question will be, as always, if you can see 8 on the good end of the range, you might see some ugly numbers on the bad side of the range. So it might look good at 5 times normalized, but if you have to own it for a period where it's earning $2, it's not going to look as cheap in the short term. So you have to really have confidence in terms of that normalized earnings power.
Anirban, any questions? Or
I just have one question. So what happens if as sort of used car prices falls, right? So used car prices went up because there was like a lack of supply, then used car prices normalize. So that would actually be net negative, right, to the loans that they currently hold, because a lot of them could become impaired, right? Mm-hmm. And people might just say, take my car, I'm not paying the loan, for example. But on the longer term, though, as electric vehicles become more popular, doesn't that, in my mind, theoretically, the gas car prices are basically going to zero, right? So, if you have a lot of a loan book that is with these gas cars, does that theoretically mean that you actually have potential impairment maybe 5 years down the lane? How do you think about that?
Yeah, it's a very relevant point. It's especially relevant for Ally because they came again out of this period where again they were essentially a captive financier to certain OEMs, and they've diversified their business over time. And now they've started to press more aggressively on diversifying outside of auto as well. So I think they have time to make this transition. Obviously, if somebody buys a gas vehicle today and is going to pay off a loan for the next 7 years, that car's probably going to stick around for a while. But yeah, they'll need to make the transition as time goes on. In terms of pricing, it's part of the reason why I like this business, and particularly asset class they're writing into. It strikes me as a bit different than homes, obviously, in terms of being underwater, what the dollar value actually means. It's a lot different to be 20% underwater on a $500,000 house than it is on a $15,000 car in terms of dollars. And, as we saw during the financial crisis, this asset class actually performed very well. The other consideration is the duration of the loan, right? If the price goes down 15, 20%, but you're 2 years into paying off a 6-year loan, the math there is just different as well. So I think there's certain characteristics about auto that I like, but to your point, I think they're continuing to diversify, the credit book. And I think the market rightly has some questions about how well can you really learn how to do these things. So yeah, it's part of the risk of the business.
All right. So the next stock we're going to share is Domino's Pizza. So Domino's is down about 30% this year. It was down significantly more just a month ago, but it's seen a little bit of a rebound the past month. Its market cap was once exceeded $20 billion. It's now about $13 billion. So Domino's Pizza is, full disclosure, I own a position because of its franchise and supply chain business model. It's not as simple as every dollar of pizza sold directly translating to $1 in their corporate offices coffers. The company oversees about 6,600 restaurants in the U.S., more than 12,000 locations across 90 international markets. Nearly all of Domino's locations, both foreign and domestic, focus exclusively on delivery. That's approximately 2/3 of sales, and carryout, about 1/3 of sales. So those are which are the two largest segments in the quick service pizza category. But all but a fraction of these locations, about 5%, are franchisees. Franchisees, they pay a 5.5% royalty fee on sales, an additional 6% for marketing. More than 95% of U.S. franchisees started as an employee in Domino's locations as an hourly employee, and then they go to this training course before they're granted franchises. I think that's a real advantage for it. Domino's uses its company-owned stores. Like I said, they have about 5%. They own the stores to act as like a testing ground for new products, promotions, and technology, and believes that operating its own stores makes it a more credible franchisor. So right now, why is Domino's down? So I think excluding the negative impact of foreign currency, global retail sales grew almost 5% in the last quarter, but on a 3-year stack, it's a positive 28%. And so I think that goes to one of the main problems it has is COVID, right? When 2020 happens and the world shuts down, and so but people weren't making every single meal, so they were ordering delivery a whole bunch, and so as they're ordering delivery, Domino sales spiked, and they're still kind of going through the impact of that. Same store sales in the U.S. last quarter was up 2%, but again, on looking at that 3-year stack, they're up 18%, which is that's much better. Carry out sales, which they're really focusing on lately, is up almost 20%, and on a 3-year stack, they're up 35%. That's important because delivery is just much more labor intensive, and so they're really trying to promote their carry out sales more. And then also besides their comparables being messed up by COVID, it's also inflation. Domino's gets hit hard by inflation on 3 fronts. You have food cost, you have labor cost, and you have fuel. So that's a triple whammy for Domino's that they're really taking on the chin right now. But on the positive side, the entire industry is taking it on the chin too. And relative to its quick service restaurant peers, Domino's is in a much better position to tackle these problems. Their main ingredients for their food is dough, cheese, and tomato sauce, while competitors have to worry about prices for much more expensive items such as beef, chicken wings, guacamole, usually almost always some kind of protein. Where Domino's, they can throw a few slices of pepperoni on top of a pizza, but it's really not their main price concern. That gives Domino's a huge advantage on margins. And I actually think they have pricing power. So they've already they've gone earlier this year, about 6 months ago, they have this, their promotion. They always do this mix and match deal, and it was $5.99. So pick 2 items from, this menu of options, or pick however many options for this menu of options, and it was $5.99 for each item. So it could be a medium pepperoni, or their chocolate, some kind of dessert, or some breadsticks, or whatever, and they increased that to $6.99. So that's right off the bat, that's a very easy 16-17% price hike right there. And then last month they just did it for their carryout mix and match deal too. It hiked delivery first because it said wage increases are almost always permanent, whereas food prices, they're more volatile, and they just wanted to see if food prices would come down before raising its prices. But I think that's a very easy price hike, because even for the most price conscious customer, paying $6.99 is still a really good bargain. It's just for myself, feeding my family, it's just by far the cheapest option we can get that the whole family enjoys. If I go to Chick-fil-A, it's $10 for every value meal we get. So 6 people in my family times 10, that's a $60 night. If I order Domino's in, we can get 3 medium pepperoni pizzas, and it's we're coming in right in under $20. So it's a huge price advantage for a value conscious customer. And if times get tough, I think that'll be even more to Domino's advantage. They have a history of, let me share this screen real quick. They have a history of just being very innovative, especially in the restaurant industry. In 2008, Domino's launched the Domino's tracker so that customers could see exactly where their order was in the pizza making process. Last year or a couple years ago, GPS was added to that feature so customers could see their orders for deliveries in progress. Domino's promotes its Anywhere platform. That's AnyWare platform. It works across more than 11 platforms. It makes ordering a pizza as easy as tweeting a pizza emoji at Domino's or asking Alexa to order a pizza. In 2017, the company introduced Domino's delivery hotspots. That makes it easy to order pizza to locations without an obvious address, like a pavilion at a park or a spot on the beach or like a place, on a college campus, like the student union at the college or the campus greens. To date, more than 200,000 hotspots have been added to its database. It also, like as far as its brand goes, like, whenever I talk about Domino's, people talk like how much they hate the pizza or whatever, or talk about how much like they like some other kind of pizza better. And to that, it's like, of course there's pizza that's better, right? This should never be compared to a nice Italian restaurant with a brick oven or something like that, where I might take my wife out on a date night. But their brand, I think there is still something to it. It has more than 29 million active users for its rewards program. I believe that's more than any other quick service restaurant, but don't quote me on that. More than any other restaurant, like even more than McDonald's or Starbucks. More than 75% of Domino's orders in the US are now placed digitally, which is a huge advantage, right? Because the more orders that like come in electronically, that's less time somebody has to be spending at the restaurant, manning the phone, writing down the order, and things like that. So you're just taking out manpower, which just cuts their cost even more, gives them more of an advantage. And finally, like their return on invested capital is just incredible. Look, I'm showing a chart right now that like shows a few companies, some in their industry and some not, just as points of comparison. And this obviously is not far from like exhaustive list, but like their return on invested capital, like Apple has on this x-axis is return on invested capital, the y-axis is the PE ratio, just as a simple valuation metric, but the return on invested capital is over 50%. And that's actually down a little bit from the last couple of years. It was in the mid 50 percentiles for a long time. Starbucks is 46%, Chipotle is 36%, Papa John's is like 23%, McDonald's is like 21%, just as comparables. But even like over companies like Visa, Microsoft, Google, its return on invested capital, it's really, really incredible. I really like this company. I like I said in the beginning, I own a position, and I think it's positioned to do well, whether the economy goes bad or recovers.
Well, I was going to say that, I can never dislike a company that shows two Apple iPhones and an Apple Watch in the screen of where they're using technology. So they're just behind Apple in terms of, return on invested capital. But, I'll tell you, the only thing I was going to say is every year I look at this company and I think, how can this company grow its same store sales? How many more pizzas can people have? How many more stores can you have? And the answer always seems to be more. I don't know how it happens, but the answer always seems to be more. So
the international market.
Do you not?
Yeah, I'm sorry. Keep going.
No. But like so, and Domino's has a weird Domino's. There's a listed version of Domino's here in the Australian market, and I always thought that the Domino's market in Australia is, for example, very saturated. But this company still throws 5, 6, 7. There are years when it does like 8% same store sales. I just do not understand, how that happens. How many more pizzas can people have? So just help me understand that.
Well, so what's great about pizza, like it's cheap, right? Like I already talked about that. It's cheap. It's very versatile. So you can go internationally and like in their 10K, they talk about like some of their more exotic pizzas in different places. And it's like I don't even want to say it, but like in Korea, they have this like octopus bomb pizza or something. And, in India, they have like a corn and cheese pizza, so it's just a very versatile food. Like it's basically just dough, a sauce and a topping, right? And maybe some cheese, right? That's all you need. And I mean, from my thinking, that probably translates pretty well across the global market. And it's really like going back, like I can't emphasize this enough. It's really cheap. If I go to Chick-fil-A or McDonald's or, any other place with my family of 6, and we all get like value meals. That approaches $10 a value meal. Whereas Domino's, $6.90, which is after their price increase, $6.99 for a medium pepperoni. I can get 2 or 3 of those and feed my entire family. My kids love it. It's not the healthiest food, granted, right? It's not the healthiest food, but neither is any fast food. And and granted, like, yes, I've had better meals, right? But it's edible enough to get the job done. And like with their Anywhere program, like, they really they sell affordability and they sell convenience, right? So this Anywhere, the hotspots, like all that stuff, it's just to like take any friction out of ordering pizza. Like they even have this 0-click app where you just click the app and your saved order is saved at your favorite, your preferred store, and it starts a timer. And then when the timer goes off, it just automatically orders that order it. And like my wife, like we've moved, and I've told this story before, but on her commute, she knew exactly where to hit that button. And so that when on her way home, she passed the Domino's close to her house, and she would stop and she would just pick up the pizzas and keep going, like on a Friday night, and she could do that in traffic. She doesn't have to look at her phone. She just hits that button. They just keep thinking, even during COVID, when they did the car side pickup, right? So lots of places now you go, like I can go to Pizza Hut or Papa John's and I place an order on an app and they'll bring it out to my car. Well, when you go to Domino's, you hit that you're there, given if it's like they say, be here in 15 minutes. So as long as it's after 15 minutes, you hit the button that you're there and it starts a 2-minute timer. And if they're not out there with your pizza within the 2 minutes, they give you a coupon on your next order. Just little things like that make a big difference. And I've never gotten a coupon, by the way. You know what I mean? But I know if I go to Domino's, they're going to get me out that pizza in 2 minutes, which is just like those kinds of things make a big difference. That affordability and that convenience.
Yeah, my question is basically about that exact point. It seems, correct me if I'm wrong, and maybe even tell the story because it's a pretty good one. It's about 10 years ago now that they made kind of a switch in their marketing, and it was obviously very successful. Well-known tech investments, reduced friction, cheap prices, as you've said. Seems like they've consistently hit on things that really matter to customers. Has there been any corresponding response from Pizza Hut, Papa John's, the major players, or are they just kind of lagging?
No, I wouldn't say they're lagging, is what I would say. I wouldn't say they're not doing anything, right? But Domino's just always seems not even like a step ahead, but like 2 or 3 steps ahead. They're just terrific operators. Like I said, their loyalty program with 29 million members. Like, how do they have more than McDonald's? How do they have more than Starbucks? Like that doesn't make sense to me, right? It doesn't make any total sense to me. Like that Domino's would have more than those kinds of restaurants, but they do. Like if you had bought this at the depth of the financial crisis, like, I mean, I could tell the whole story, but like it would be, even with its price drop now, it would be over 100 bagger. Right. So it just has done an incredible job. And like one other quick point, but like to their competitors, a lot of times Pizza Hut, Papa John's, what they try to do is like they'll introduce like some exotic item, right? Like on the menu. Like, so now like Papa John's has Shaquille O'Neal involved. So they have the Shakaroni pizza, or like Pizza Hut did like 30 different kinds of crust you could order on your pizza and things like that. Domino's doesn't do that. The only times it'll do a menu innovation is to see if it's a possibility to be permanent, like a permanent addition to the menu. They want a very simple menu where you just order like your basics on the pizza. They don't want to do like the crazy like pretzel crust stuffed with cheese and some weird topping that they're not going to do permanently. They want it to be simple, so they can focus on speed and convenience.
And what was the do you remember the marketing campaign they did? Just because it's funny, didn't they basically trash their own pizza?
Yeah. So, well, this is how we go over on our time, guys.
Sorry, this is important. Right. This is important.
So back in 2008, you have the financial crisis going on, so everything's being hit anyways. And Domino's Pizza was like, a new CEO comes in, and Domino's is just being destroyed online for like their horrible tasting pizza. They still scored very well with convenience and delivery and things like that, but their pizza was just getting destroyed. So they come in with their marketing, and they basically did this like apology tour right? And like they have videos of them going up to these people who left really negative reviews online, say, hey, we saw that you gave us 1 star and you hated our pizza and you said it tasted like cardboard. Try our new pizza, right? And they have the cameras rolling there and it's all very like, like edgy commercial, and they go up and the new people try it and of course they love it, right? And but they basically apologize. They're like, hey, we're sorry we sucked for so long. Take us back, America, and then off to the races from that point on. If you had bought the stock right when they launched that campaign, I mean, you're very rich right now.
Nice.
All right, and Anirban, our next stock is ServiceNow. ServiceNow is down 42% this year. Its market cap has gone from, let's say, $140 billion to $81 billion. So it's taken a substantial hit. Anirban, is ServiceNow a wreck or a rebound?
Well, ServiceNow is like, I sort of think, if you think about software as a service and you think about like sort of the blue chip software as a service companies, standalone software as a service companies, then, well, the biggest one of them is Salesforce. And then, the next really, the big one is ServiceNow. And this is really a story of organic growth. And what they really do really well is I sort of think of them as the integrating glue. So they automate things for people, automate HR workflows, automate IT, service management workflows, automate, a lot of ERP things. So the automation by integrating with other applications is really their bread and butter. And they've done a fabulous job of this over the years. It's never been a high flyer in terms of growth. It does a steady, 20, 25, maybe 30% revenue growth. It throws off a lot of cash and, operating cash flow, profit margins in the high 30%, or 30% or so. So the only explanation really I have for like, if almost every other company has taken a hit. Every growth company has taken a hit. The multiples have come down, but the multiple for this one now is, it's gone down to like 10 times sales or something like that, because it's projected to do probably 7.5, 8 billion maybe next year in sales, 80 billion. So call it that 10, 11 times in sales. It's always enjoyed a bit of a premium, which in the higher interest rate environment maybe it doesn't deserve. And so, you could justify it being okay, but the company has executed really well through the tightening of IT budgets. They seem to be doing just fine. The biggest headwind for this company right now is foreign exchange. That's been the headwind story for a lot of big tech companies. That's the story here as well. So constant currency growth looks really solid. It's getting close to 30%, but you're facing 500 basis points, 600 basis points, 700 basis points of FX headwind. So that's been the story. But if you go to the next chart, or the only chart I included, is like if you look at the history of this company, that free cash flow margin, right? It bounces around. So that really depends on how cash is coming into the company and how cash is going out. Typically, the last 2 quarters of the year are when sort of, they have a lot of cash generation happening. But settling somewhere around an average of, that 25, 30%, converting 25, 30% of the revenue to free cash flow is pretty awesome. And I don't see how this stops, right? And it's been free cash flow positive for a long, long time now. And it's just become bigger. It's got a very big book of remaining performance obligations. If you're looking for like a SaaS company, a software as a service company, you want a company which is a blue chip style company selling for a decent valuation, this is it. This is the company to look at. And it's got Bill McDermott now leading the company, which is really good. It's flamboyant and it's got a great CFO.
Why is the free cash flow so cyclical like that? Why is it so volatile?
Well, it's so cash flow would depend on how much you're generating cash from operations, right? So that would depend on a lot on the billing cycle, right? So if depending And when the bills are issued, that's when the cash is coming in through the door.
So like I have a position in ServiceNow, actually a fairly large position. It's a top 10 position for me, and its platform just seems so incredibly sticky, right? I mean, that's like that. What I always look for in software, like it just seems like the more they're a platform rather than like just a single app, like they can get
Yeah.
very sticky very fast, and they don't lose those customers, which leads to pricing power and all kinds of other good things. Like what do
Yeah.
they? I haven't looked at them too recently though. Do they talk about their churn rate or where it's at?
That's a great question. So yeah, so like like I've had this for a while. This is not a shoot the lights kind of company, but it's like a market beater over the long term by a decent margin. It's so, and the churn rates are very low. Part of the magic here is exactly as you said, right? So it's a platform that is basically a glue for all these myriad different applications that people use, and automation of those tasks. Once you build this into your workflow, it's very difficult to undo, right? So they're sort of riding the cloud wave, the application wave, the digitization wave. They're like, if you want to ride those waves, this is almost like the picks and shovels company for that sort of wave. And churn rates, it's one of the few companies that actually provides the actual churn rate for customers. It's like it's like 1% maybe in some years. It's like their retention rate is between 98 and 99%. That has been historically that. So that is pretty phenomenal. And part of the reason is again that, and the other reason is that they have basically got enterprise scale customers, right? So it's not, they don't have a lot of companies that see higher churn rates are the ones that serve a lot of SMBs. So those small clients, those businesses tend to go out of business. They have to do a lot of cost cutting. If you're serving, so last quarter, for example, they had a 250 million deal. This number might be correct or incorrect. It's off the top of my head, from the U.S. federal government, right? I mean, like those sort of deals are huge, like 250 million deal. And once you're embedded, it's unlikely that you're going to be cut off. So that's I think the story
Not
there.
by the
That's
government.
very strong. Yeah. So they're just incredibly sticky, and it's just value proposition, and they're very innovative. They keep innovating, basically going from one service line to another. So they started off as IT service management, sort of moved into HR, now moving into sort of microservices and all, so basically slowly but steadily finding this word. So the land and expand really works well in this sort of situation. So again, just steady execution, good execution, low amounts of dilution. If you think of stock-based comp, then they're looking at basically keeping the dilution at about 1%. Which is sort of maybe acceptable if you're growing at that sort of 20-25% rate, and you're cutting a lot of the revenue to free cash flow.
I didn't realize the share-based compensation was that low. I actually thought it was higher for them. So interesting.
No, but it's a pretty big company, right? So this is
Right.
Yeah, so it's a pretty big company, but its revenues is pretty large. Its remaining performance obligation is also large, right? I think the share-based comp is a problem for young companies, which temporarily had very high valuations and multiples, and therefore could afford a lot of stock-based comp. And in this current market, where if they've lost 80% of their value, then they have a problem, right? But this, is a different story, I think, for the larger companies and their stock-based comp. So I think it's reined in quite a bit, and they know that they need to rein it in further. So they've always made sure that they don't overdo it.
So the same stock-based comp as Snap, it just has 10 times the market cap, probably in dollars.
Yeah. Just a story for a lot of companies, right? I mean, if the stock-based comp that you can do at 40 billion market cap, you can't do the same stock-based comp at 8 billion market cap, even if your revenue is larger, because the dilution would just kill you, right? And it is strange when a lot of CFOs just do not understand that. I mean, it should be pretty obvious, but I would think that would be one of the things that a CFO understands, but a lot of CFOs seem to not understand it.
Alex, any questions or?
No, I think it sounds, my question is, why have I not looked at this sooner? But I guess the stock's down, which is why we're talking about it. So I need to do the work.
Actually, yeah, I actually think it's an interesting one. I like it. I personally like it better than Salesforce for those like, really large tech companies, but not quite a mega cap. Yeah.
It's not as acquisitive. So it's a lot of the growth is basically organic, whereas for Salesforce, you have to sort of account for the fact that Salesforce is very acquisitive, which makes looking at its numbers really difficult and understanding sort of, how its comp base is growing and everything. So yeah, this is a very unlike Anirban company, and this is a more Alex and Matt style company, I would say.
Sure. All right, so let's move on. Let's talk about Five Below. But Alex, first, we're looking at a lot of like when you go through your companies, we always look at these really cool graphics and images you share. Where can people find more of those types of graphics?
Sure. I should disclaimer real quick too, because you said it on one of the names. I own Ally and I own Netflix, which we're going to talk about. I do not own Five Below. So just for complete disclosure or transparency. But anyways, yeah, I share all of my work through, as you said before, the TSOH Investment Research Service, which, long story short, I worked as a buy-side analyst for about 10 years, and I decided to leave in April 2021 to launch this service. And I provide, a write-up every Monday and every other Thursday. And essentially what it is complete transparency into my research process and how I invest all my savings and anytime I make changes in the portfolio, et cetera. So I cover companies like Airbnb, Netflix, Ally, Berkshire, Microsoft, and many, many others. So it's just a completely transparent view at how I think about investing and what I do as an analyst.
And if you're interested in learning more about Alex, you can search our podcast. And like my first interview with him, I think you were just launching your service, Alex. And we talked about your investment philosophy and things like that. So be sure to check that out. Five Below, the retailer, it's down about 30% this year, was down over 40% earlier this year, but it has rebounded a little bit. Its market cap is now $8.5 billion. It was over $12 billion earlier. Alex, is Five Below a wreck or a rebound?
Yeah, so Five Below is a really interesting company. Just speaking to a moment ago, the companies that I followed, retail tends to be one area that I focus in on a decent amount. And there's certain pockets of retail that I really like. Costco and DG are two examples. Dollar Tree is another one. And Five Below has a certain part of it that strikes me as similar to an early Dollar Tree. And for those who don't know, Five Below is a retailer that focuses on selling products for $5 or less. They're experimenting a little bit with something called Five Beyond, which pushes the price points a little bit higher, but generally $5 or less. And they really target teens and tweens. And there's a great interview that I linked to in my deep dive with one of the co-founders, and he talks about how they basically saw a gap in the market that wasn't being served, and Five Below has since proven that they have a model that can serve that market. It's a name that for a long time generated a lot of sales growth through a combination of comps and also aggressive new units. And they continue to have the posture of adding a lot of units, as we'll show in a second. But they're dealing with some COVID tailwind and potential hangover, as I'll jump into. So let's go to the next slide. Yeah, so this is the store count for Five Below. As you can see, they reached 1,000 units in 2020, which was 18 years after the company was founded. The projection that management has put out publicly has them reaching over 2,000 by 2025. So 18 years to build 1,000 stores, 4 years to build the next 1,000 stores. So just speaks to the aggressive expansion of this business. Next slide. Here's the margin profile by year. As you can see, 2020 was impacted by COVID. Obviously, they were closed for a period of time. 2021, a really nice rebound. You had stimulus payments. You had generally favorable macro. Now we're into 2022, which is where things are starting to get really interesting, as they are with other retail names. And I think this week the Target conference call was a great example of Walmart is, in my mind, pretty similar to DG, which I own. It's more of a grocer than anything else. It's selling food and bev, and it's selling consumables, and that's really a huge part of the mix. That's certainly less true at Five Below and Target. And I think 22 is going to be a really interesting year. Next slide. Yeah, this shows Five Below's EPS by year, which basically shows an EPS form, what I was just saying, which is this business had a huge tailwind in 2021 with EPS at $5, which was, up from $3 basically in 2019. Now in 2022, the current management estimates at $4.40. It should be noted that at the start of the year, they were at around 540, I believe. They cut after the first quarter call to, I believe, around 490, and they cut again after the second quarter call to the current 440. As I've been tweeting here recently, some of the comments from Target, Target started the year with the idea that they were going to have 8% plus operating margins. And now as we head into the fourth quarter, the number's closer to 3 and change, which is obviously, a massive hit to operating income, down 50% versus kind of expectations. I'll be very curious to see when Five Below reports here in a couple of weeks what they're seeing relative to guidance. I don't know if you have another slide or not. Yeah, this just shows the kind of the EPS slide that we've seen here as of late. I never want to be overly focused on short-term numbers. I think this is a very interesting concept, and as I wrote about here recently, I think there's reason to believe that this has a unit count opportunity over time that is, beyond the TJ Maxx, Marshalls, those kind of names, which are in the 1,500 to 2,000 unit range, call it. I don't know if it ever gets to Dollar Tree, which is closer to 8,000, but I think there's a path to 3,000 plus here. So could be a very interesting story given the unit economics, but in the short term, I think there's potentially more messiness ahead.
So I love this company. I've never had a position in it, but I think it does a lot of things right. And it's like COVID just messed up so many things, right? I mean, just investment wise, and not talking about like obviously the horrible everything else, but just like the growth comps. I mean, like you see it jumped to, like, if you had said in 2019, hey, we're going to be at $4.40 EPS by 2022, that'd have been terrific guidance. And all of a sudden, but because they had $5 in 2021, now it's like, every, same store sales are down, or, or whatever else. And you see that just over and over again with so many of these companies. I like Five Below. Like you said, they really do target the teen and tween audience, which is like great for their price point. Like I have, like, between tweens and teens, I have 3 in my house. And Five Below is definitely, when they're just living on an allowance, that's their favorite store, right? Like they just love to go to Five Below. They'll be room decorations or candy or toys. And Five Below does such a good job at capitalizing on those like stupid trends that like catch a big wave, like the fidget spinners, like 4 or 5 years ago were a big hit, and you would go in Five Below and they'd be everywhere. Now it's like the squishmallows, or those like snuggly, like cuddly, I don't know if I say it right, but squishmallows are everywhere. Like that was a big trend, and they were, they're everywhere in the store. And they do a lot of things right.
Yeah, I think on the first point, I think it's, as it relates to, where the numbers are today versus where they were a couple of years ago. In the most recent update I wrote, my short-term concern is that Five Below experienced huge business tailwinds throughout the pandemic with 2-year stack comps at 25%, up 25%. Will those gains prove sustainable? And if not, what does the path to normalization look like, timing and magnitude? And, as Target is showing right now, magnitude can be a lot bigger than you think it may be. Again, it's 1 year potentially, or 2 years, but it's, just thinking through that in terms of how you value a business. And, to the other point, it's one of my favorite things about retailers, following them as an investor, is you can walk in the store and really get a feel for what it is in a way that, it might be a lot harder to do, obviously, if you don't work in a large enterprise and you're seeing the software, for example. It's just when you walk into a Dollar Tree and really understand what it is relative to a Publix or a CVS or a Dollar General, to the extent that they're ever in the same market, which is relatively rare. Same goes for Five Below. To your point, I'd encourage people who live in the US, just walk into one and see what the product assortment looks like, and look at how people are shopping the store. And you can start to appreciate how this is potentially a defensible niche that they've dug out for themselves. So like you, I like the company a lot. It's not a name I've ever owned. I've probably followed it for a handful of years now. There's a price where I'd make a move. We're not there yet.
I think it's at, like, I'm just looking at Morningstar, it's like 35 times earnings now. Where theoretically, where would you start really considering it?
I mean, the question is that 440 number. I think I wrote this exactly in my article. It's management has this view of baselining in 2022 and then returning to this strong double-digit growth trajectory. And the question is, what is 2022 going to be, first of all? And is that actually a path that we're going to grow off of? And I think it's tough with a lot of these retailers to actually nail down that question. It's part of the reason, honestly, why I've been invested in Dollar General for a while now. And one of my early comments on it was, I think that the COVID tailwind followed by hangover is going to be played out differently there than it is in a lot of other names. And I feel much safer with kind of the normalized profitability in this business. And I get a little bit scared on what I see other places. Now, I didn't foresee that Target's operating margins would go from 8% to 3%, but it's kind of, generally speaking, what I was concerned about. And they just have certain dynamics to their business that make me less scared. The deep dive I wrote on Five Below was titled, "We Sell Stuff That Nobody Really Needs." It was a quote from the co-founder, and it's true, but they're competing in they're competing in they're competing in discretionary categories, and a lot of their customers, the air quotes income is allowance from their parents. And if times get tight, those are categories that could struggle. So again, I'm very curious to see how these Q3 results look in a couple of weeks, and also how management's thinking about the end of the year and what life looks like as they head into 23.
Anirban, any questions?
I don't have any on this. Is retail beyond my pay grade.
Okay. All right.
They sell fidget spinners. Come on.
You have kids. But I guess they don't have any in Australia, so we'll give you a pass.
They'll try to get there someday.
All right, so the next company we're going to discuss is Amazon. I don't think I really have to go through what this company does. So just real quick, it's down almost 50% this year, which if you had told me at the beginning of the year, I just would not, I don't think I would have believed you that it was down this much. Its market cap is now, it was approaching $2 trillion for a while, and now it's under $1 trillion. So it's definitely seen a huge hit. Its net sales this last quarter, they're still up 15% for $127 billion. That, there was a $5 billion unfavorable impact from year-over-year changes in the foreign exchange rates. Otherwise, net sales would have been up 19%. But it's not revenue that's was the problem. Its operating income was down almost in half to $2.5 billion. Free cash flow decreased to negative, basically, an outflow of $20 billion, where 12 over the trailing 12 months, and the previous trailing 12 months, it was an inflow of almost $3 billion. So that's obviously a concern. They said for the full year 2022, they expect to incur approximately $60 billion in capital investments. That's a bit of a reduction in its fulfillment and transportation capital investments, but that's offset by additional investments in its technological infrastructure for AWS. So is there good news? I would say, so full disclosure, this is my largest position. AWS sales increased $20.5 billion. That was up 28% year over year. That now represents an annualized sales run rate of $82 billion. We'll look at the margins for that in one second. One of the things that happened, though, Amazon saw an uptick in AWS customers, really focused on controlling cost. And Alex, I'm sure you read through the Microsoft conference call, and they were and in Anirban, we did a previous podcast on Azure and AWS, and the comments from both conference calls were just so similar about customers really focused on controlling cost, and how AWS was proactively working to help customers optimize for cost. And so I think, so here's a quote, but basically this is a quote from the CFO. But basically what we see is customers are looking to save money versus their committed spend. We have options for them to do that. They can manage workloads better. They can switch to lower cost products that have different performance profiles. They can switch to Graviton chips that have higher cost performance ratios. So all really good things for the customer and for Amazon long term. And then, so then he keeps going, talking about the benefit of cloud computing. You can give customers, like, you can turn what used to be a fixed expense into a variable expense. And that's really how cloud has been advertised for the last 10 years. So I think it is good in the long term that AWS and Azure like are following through on that right now as we're seeing more macro uncertainty. But in the short term, they're seeing like demand drop. So just like looking at the numbers real quick. So if you're looking for us, like their online sales, their online store sales grew 7% year over year. That's 13% if you exclude the impact from the foreign exchange rates. That's at $54 billion. But everybody always talks about the low margins that the online stores have and how much money is going out the door, especially this last quarter internationally. But why I just continue to believe in this company, like the CapEx they spent on the fulfillment centers and the logistics, and to get this delivery down to like for now, a lot of items that I order where I live, it's same day or next day. In fact, like I gave this anecdote the other day. So forgive me if you already heard this, but like my son asked me to order something for him on Amazon the other day, and I did. And when he, that morning, and when he came home from school, he's like, "Where's my package?" And whatever, it was getting there the next day. But like that expectation, I think, for young consumers is like, well, why isn't it here yet? And like we're like, I consider that like a miracle, a modern day infrastructure. Like I think younger consumers are just going to expect that. And around their online stores, their third party seller services, that was up, excluding foreign currency, that was up 23%. Subscription services, basically Amazon Prime, was up 14% to $9 billion. Advertising services, which is almost exclusively around their online stores, that is now almost $10 billion. That's basically half of AWS. And that grew 30% year over year, excluding foreign impact. Last year in the third quarter, it grew 52%. So even lapping these huge comps from a year ago, it's still growing at an incredible rate. And then, of course, look, you still have AWS, which grew 28% to $21 billion. So I just think, like a few quarters ago, they basically said, like, look, we overspent on CapEx on some of these fulfillment centers. We overbuilt. We saw the demand like just spike for COVID, and we thought that demand might be a little more permanent than it ended up being. It turned out to be, it was a little elastic. Basically, I mean, like right now, I think every company in my portfolio made some kind of mistake during COVID about demand and lapping its growth rates and things like that. Amazon was no exception to that. But it's not like we'll talk about this more when we get to Netflix. But like the comparison I make, like when Netflix spends on a show and it's a bomb, I just feel like, well, was that worth it? The CapEx to me is kind of the money they spent on that show or movie. Like I feel like it's just gone. But when you spend on a fulfillment center, it's there. It's a real physical asset. It's there forever. And I do believe e-commerce demand will continue to rise. And I don't think Amazon's going away. And they have all these fixed costs, and eventually that's going to leverage into a lot of free cash flow. At least that's what I think.
I own the shares as well. Go ahead, Alex.
Go ahead. No, go ahead. You're good. Go ahead.
Okay, so I'll just to be less bullish, because I personally own the shares in this company. So I think my thinking now, I've had such conflicted feelings about Amazon. The way I think the valuation cut that they've got is partly deserving, because when a company which is like almost a $2 trillion market cap company does not produce free cash flow, and then the market's got to say, well, if you can't consistently produce free cash flow, then what are you worth, right? We can't really evaluate its worth. At its peak free cash flow, it only produced $25 billion of free cash flow, right? That's peak free cash flow that I have seen, $25 or $26 billion, right? So there's something there about their cost structure, and we can say that, well, it's just pushing the free cash flow into the future. But for a company of this size, the future should be now. And the two problems that I see, I think, is, and again, this might turn out to be premature speculation because, maybe there are these, this intermediate costs that they're taking because of the COVID demand that they've seen, and therefore maybe they're overcommitted. But the cloud infrastructure, at the infrastructure level, I think there's more competition. And because of more competition, I think there's more, I guess, let's build more data centers, let's build new, hardware, and that's pushing the cost up there. And with more competition, if you think like, Oracle wants a piece of it, Google wants a piece of it, Microsoft wants a piece of it, ultimately, I think it just causes some pricing pressures and therefore reduces margins. I think the other thing I'd say is that I think if Amazon wanted to be consistently free cash flow positive, maybe one of the things is it could just jettison its international sales, Amazon International, and maybe it'll actually become a more, more of a, consistent free cash flow, because that international business really has been a drag for a long, long time, right? And, the question to ask maybe, is it worthwhile or not? So I don't know. I feel a little bit mixed. And as I said, I've owned shares for a long time. I've not added recently, but I just feel like I want to see them generate consistent free cash flow, which would be really nice if they can do. It doesn't have to be a lot. Like, just to put contextualization here, right? I mean, Apple is at 2.5 trillion or to generate 120 billion or 112 billion dollars of free cash flow. Right? So that, I mean, the free cash flow difference between say Apple and then Google and then Amazon is like huge. So there's a reason why I think it's been shellacked. And I think this is something that they're probably addressing with cost cuts and things like that. They've tried too many things. They don't need to try too many things. Having 10,000 people on Alexa, that's really stupid. Having so much investments on devices, you're not a device company. Don't spend so much money on devices. You really don't need them. So I think those sort of cost cuts and a little bit more rationalization, I think would help. So I'm hoping Jassy does the right thing and brings the cost under control and therefore generates free cash flow.
Yeah, I agree with everything you guys have said. I have basically one comment from two different angles. I mean, on the one end, that's really positive for Amazon, I think, in some ways, is, you look at what Walmart's done over the past decade or so. I mean, it's a company that generates 600 billion in revenue a year, something like that. They've taken a material hit to EBIT margins over the past decade, largely as a result of going after e-commerce. They built a fairly decently sized e-commerce business in the US. It's around 40 or $45 billion a year, I think. But kind of to Matt's point, I just really struggle how they ever get to the point where the mind share that Amazon has built and the expectations they've set for customers. It's just so hard to compete with that. And I have all the respect in the world for Doug McMillon at Walmart. I think he's done a fantastic job. It's just very, very difficult. And their reticence to give any real numbers, as far as I've seen, around something like Walmart Plus, the subscription service, probably in some ways kind of speaks to that. It's just such a tough hand. On the other side of the argument, though, to Anirban's point, testing and experimenting and doing other things certainly has merit at some level, but Amazon does spread themselves pretty thin. And I'm somewhat biased in this because I own media, but I look at some of the dollar amounts that they're spending on video, whether it's, entertainment programming or, for example, spending $1 billion on the NFL, and, ratings are down very, very significantly from what they were when they were on linear. And I just wonder at times if whether or not solely focusing on the value proposition that, you're talking about with your son when he orders that package, if it can get spread too wide. But not to say that I'm totally against the things they've done there, but I do think that is part of the risk to this business, that you potentially lose focus and you start adding things that maybe don't actually add a ton of incremental value for customers, but you're charging for on Prime at the end of the day.
Yeah, so I think there's a lot of places we can look for where they can cut costs, but that almost makes me I just think there's, I guess, a lot of low-hanging fruit there, right? That they can turn off. Let's talk about Prime Video. And like they've said in the past, Prime Video really, it doesn't do much in the US market, but we've actually seen success for it, in the international markets more, where they don't have logistics infrastructure that they do in the US. So that's another way to like hook more prime customers. But to Nirvan's point, they should probably look more closely at some of the foreign markets there. And I think Europe is a great place to be. But then you start looking at some of the more emerging markets there, and I mean they spend a lot of money in India, like that might be worth it, but maybe like some places in South America where there's already some other e-commerce players, or even in around the globe, like it's not worth it. So I think there's a lot of low-hanging fruit there, right? Like I don't think they needed to make a Lord of the Rings show that, even though I don't know if it seems like it's been bombed on social media, but like I enjoy it. I enjoyed the Lord of the Rings show, but do they need to spend that much money for just the IP on it alone was like mind-boggling, and then the production costs were just even more. There was somewhere I read, and I'm going to mix up these numbers, but like where they talked about Game of Thrones being on HBO and how much like the production cost went up as the season ran because it's a very successful show. But in the first or second seasons, the production costs were a lot lower. And like, in fact, like there's a few scenes, if you watch that show, like there's about to be a big battle, and then it just cuts to after the battle, like the aftermath. They don't show the battle, and that's like, just a way you can kind of tell a story and, maybe like tease viewers a little bit, but like, keep costs down. And, one thing like Amazon could do is certainly like look at some of these costs. I mean, the NFL experiment, I actually think that might be successful. Like, I think paying for live sports can actually be a smart move. They said like the first broadcast of the first NFL game, that was like the best numbers Prime's ever had in a 3-hour period. Like, I don't know what that means. That seems like a very cherry-picked stat, obviously, but like I think if it can drive, like something like that could drive Prime numbers, whereas a Lord of the Rings show, I just don't know who joins Prime to watch Lord of the Rings. So I just think there's a lot of low-hanging fruit here. They seem like every company right now, so we'll have to see how they do it. But they seem like they're committed to going through this and cutting out like the extraneous costs that aren't worth it long term. And I think over the next several years, I don't think it's going to be immediate. I think a lot of stuff is already in the works. A lot of high production shows on Amazon Prime, they've already signed the deals for it, but they're saying, look, we're going to look at these and how they do, and if they're not going to drive the right numbers, we're going to stop doing it. And I just think that the logistics, like but that's something where I don't think they spend too much money. Like, I just think like they will see real returns on that over time. I could be wrong, but people will always want things quicker. People will always want things more convenient. And I think they have a lot of pricing power in Prime for US customers, maybe not international customers as much. I couldn't really speak to that, but I think a lot for US customers, I think there's a lot of pricing power in Prime that they haven't exercised yet.
Yeah, I think it's like a lot of names that we've surely talked about today and even in the previous episodes. When companies are growing very significantly and things are going well, you can get a little bit lax on employee hiring and spending, and it's just kind of a natural. I don't think you can really knock companies when that happens. They're literally just trying to stay afloat and service customers to some extent. I think over time you test the logic on something like the content budget. Does $5, $10, $20 billion a year make sense? And obviously this is for management to figure out. You can't do it as a minority shareholder. You simply don't have the information that's required. But you look at some of the things you're spending on and think, is this our best use of, not even just money, best use of time and focus as well? Kind of to your point, or the point Bezos has made for a long time: cheaper, faster, higher quality. Maybe time spent focused on third-party listings and scam or fake listings is more pertinent than some other areas of focus like Alexa. But obviously they're navigating these challenges all the time. It's one of those things that for me, I think it sometimes are notable.
All right. So our next stock is going to be Tesla. But Anirban, before we get to Tesla, why don't you tell listeners about our 7 investing service?
Well, in 7 investing, we have 7 stocks that we recommend each month. 7 advisors put forward 7 stocks, released first of the month. There's follow-ups and updates of the stocks. If the conviction changes on those stocks, there's a there'll be an update out which would say either hold or sell. And it's a way for individuals to look at a buffet of stock ideas that cover, I would say, different areas, different markets, and allows people to build, the portfolio that suits their sort of risk tolerance levels and things like that.
Excellent. So our next stock is going to be Tesla. Tesla is down 48% this year. Its market cap was once approaching $1.25 trillion, is now under $600 billion. Anirban, is Tesla a wreck or a rebound?
Tesla is the greatest company in the making, man. It's already the greatest company, but well, that's what I think. So, well, look, there's a couple of things, going on with Tesla. There's no dearth of news on Tesla, which I think has a lot of impact on its, I think, short-term share price movements. So one of them, I guess the most prominent one, is Musk's takeover of Twitter. That has meant that he has sold a bunch of Tesla shares, has meant that he is spending a lot of his time on Twitter, hiring and firing people, which is causing a lot of noise. And, there's like constant news about what's happening, or Twitter is going to die, or he'll have to, put more capital into Twitter and things like that. So, basically distracted CEO of a company who's also CEO of several other companies, although he has said that he actually does not run the day-to-day operations at Neuralink or Boring Company, and he's only spends a little bit of time at SpaceX these days. So I mean, there's always a leadership issue. That's number one in the short term. The number two thing is a big market for EVs is China, and there's questions around the state of the Chinese consumer and whether or not they're going to be as buoyant as they have been in the past, and whether or not that's going to result in as many EV sales in China. That's part of the story here. Then so there's all, and then there's, of course, things like, other short-term noise issues like, are they going to hit the sort of target of delivering sort of, 50% growth in production this year and slightly under 50% growth in deliveries? Again, if China falls short, what happens? So all I would say is that all of these things they're all short-term issues, in my opinion. Whether it delivers 48% production or 40% delivery growth, or 49% or 50% or 45%, that's almost immaterial if you're at least for myself as a long-term investor. It's almost immaterial, because what really matters is how much of the market is shifting towards EV, and how much of that can Tesla capture. And there is right now really no competition in terms of, at least at the price range that Tesla is selling. It is by far and by such a long margin the leader that it's just, it's not even funny. So whether it's 48%, 45%, it really should not matter as long as that leadership position is maintained. That's one. There's a lot of political issues in the underplay. Musk has sort of moved from being, very vocal about politics, which is not very good for if you want to be a, CEO of a large public company. All of those things, again, adding a lot of noise to the business. But at the same time, I think the business has actually been executing crazy well. It's one of the most well-managed businesses in terms of, when it comes to capital deployment. It is frugal in terms of how it deploys capital. Earlier, you had that chart early where you compared with DMP and with Apple. It's pretty high for an automaker this early in the journey, and that is just a demonstration of how good they are at capital allocation. So it's, in terms of all of those things, it's you see this in this chart, for example, that you've just pulled up. So you look at the free cash flow that's been steadily rising. Right, there was that blip because of the COVID closures in Shanghai. Then just look at the capex. The capex is relatively steady. And this capex level actually would put a lot of the companies like Amazon and Google to shame. Like, I mean, what Tesla is able to do with CapEx is just phenomenal. So, really prudent capital expert. The thing that I really think that is great about this company is that people, I think, discount the level of technology depth that they've got, whether it comes to, especially when it comes to AI. It's not even thought of as an AI company, but I think this is the leading AI company today. When you think about the stuff that they're doing with full self-driving, for example, the beta that they have out, or their plans with, say, the robot and things like that. So I think even without any of those things, the current status quo looks very favorable to this company. They have 2 factories that are coming up and ramping up quite quickly. And I guess the final point I would say, there's a reason probably a lot of the free cash flow is coming from Shanghai. And until the factories at Berlin and Texas comes out, you could say that there is this, people think about multiples that they assign, and there might be a reason to assign a lower multiple to, say, free cash flow coming out of China because it's viewed as politically risky, right? I mean, if you do that, you should be assigning a lower multiple to Taiwan Semi, which has got fabs, in, say, China, or you should do the same thing to Apple, which has a huge presence, for example, in China. So there's all sorts of things there. But again, I think it's just the free cash flow growth story, the capex, and sort of the investments that they're making that makes this a very interesting company to look at.
Just great.
I only have one question. It's just, and it gets to what you kind of opened with, is how significant is key man risk here? If Elon, for one reason or another, was not the CEO a year or 2 from now, would that be a major negative to the story, or is this business at a point where it doesn't have to have him basically at the helm?
So right now, I don't think it needs him at the helm. The company is set up. It's got some really sharp people. I don't think he is managing really the day-to-day operations of this company currently, right? And it's just executing on a vision. The flip side, though, is that if you lose a leader, if you lose a leader like Elon and it completely disappears from the picture, it's hard to know whether or not it'll remain the talent that it is, whether or not it would be able to attract the people that it attracts today. It is like, Tesla and SpaceX are highly sought after by some of the top grads because it's the type of experience that you want if you're really ambitious. So that's hard to say, but I don't think you need him at the CEO level. In fact, from a stock point of view, it might actually be the thing that you want. You want somebody else to be CEO, or at least CEO running the company. Maybe make the CFO the CEO, because that guy is just so smooth and he just talks in the language, and it's just the right language that you want. He doesn't call anybody a nut job, a nut case, and all of those things. So maybe you need somebody to do the CEO. It would really be favorable to the company, as long as you can retain Musk in sort of the technical leadership role, where sort of the product vision, you need someone who's going to okay a Cybertruck, because those sort of products, you need somebody who's a risk taker, who's going to say that is okay to do, right? And a lot of conventional CEOs are not. A lot of conventional leaders are going to say, oh, that is not okay to do because that doesn't look like a normal truck, So I think that sort of vision, I think, is necessary, but I don't think you need him for running the company.
So for the longest time, I always admired Tesla as a company, right? To build a car company from the ground up just seems like the craziest thing in the world. Like, to even suggest it 10 years ago, right? It would be like, why in the world of all things, when you try to start a new car company? But I thought it was just a complete bubble, right? As far as the stock goes. And I just didn't understand that at all. And until a really close friend bought one. And it's not that the car was great. I expected that. I expected it to be a great car. Everything I'd read just said it was fantastic. It was the driving software package that he bought that cost about, I want to say maybe $12,000 on top of what he could get for the car basic package. And I was wow, I never thought of it as them selling a $12,000 software package on top of the car is it seems like a much better business than just being a car business, right? And you do see like how, and you know, if Tesla can keep this up, like just those kinds of margins like that, it can add on top of the car, and the kind of pricing power it comes out and the updates it can add to it, to make it even better. You know, that's pretty impressive and quite an advantage over competitors.
So one of the things that a small minority of people today, right? But and just to juxtapose, say Amazon had $25 billion of negative free cash flow, whatever, last year. Tesla had positive nearly $10 billion of free cash flow. So I mean, there's some contrast there. That you'd not think that to be the case, but that is the case. That here's a company that is very careful with cash management, that generates so much free cash flow without actually having the software free cash flow. So in a way, if that software free cash flow that you're talking about happens, we just can't imagine that the margin this company is going to have. It's just going to be insane. The margins there are going to be just unbelievably insane. So that's the upside to bat for. But even without that upside, the free cash flow itself tells a story.
Any more comments or questions, Alex?
I just think my favorite Elon quote is from John Hempton, which when he said, you basically have a person who's a fraudster on one side and then a genius on the other side. And that's a very interesting mix of person. And that's me relaying his comment, not my own perception. I don't follow Elon closely enough to say he's a fraudster, but I thought that was a funny way to put it.
Does seem to have that carnival spokesman, right? Like I think fraudster is too strong, at least for anything I've ever seen. But like, he has that. He doesn't have a quiet personality. He has that like carnival spokesman, like sales, job where he'll say things to get attention, almost Trump-like in a way, for a CEO. And but then he's also this like genius who lands rockets, after he launches them and makes an electric vehicle car company with a self-driving software package, and I mean, just incredible credentials and resume.
Yeah, like I mean, calling Elon fraud, right? I mean, you can call him fraud, but I mean, America is back into this because of Elon Musk, who's probably going to land in moon because of Elon Musk. They have an electric car company, the leader, because of Elon Musk. I mean, it's very rich. I just don't get how these people. A lot of people, I would say, I call them the pen soldiers. A lot of pen soldiers who have never done anything actually in life, never built a thing. They claim Elon Musk is a fraud. It's like, I mean, give him a break. How many things does he need to do before you stop calling him a fraud? Fraud people do not build great things. You do. You see the frauds like SBF, like with this FTX crypto stuff. That's a fraud, right? Yeah,
and,
that's a fraud.
Elon certainly has a interesting personality, an interesting way to
yes. He says bad things. He says bad things. He says politically incorrect things. He behaves in a way that is probably not appropriate. All of those things, but but he's not a fraud.
Yeah, no, I agree with that.
I'll tweet the link to I'll tweet the link to the Hampton pod, and you can hear his words rather than my poorly worded summary of what he said.
All right, Alex, take us away. Our last stock we're going to cover is Netflix. It is down right now 57% over the last year. It was down more than that, but like a lot of the other stocks we've looked at this episode, it's rebounded somewhat. Its market cap is now $131 billion. It was, it was for a while, it was approaching $300 billion. So, Alex, is Netflix a wreck or a rebound?
Yeah, I know we're short on time, so I'll run through this fairly quickly, and I've written about it a bunch for anybody who wants to read more. Go to the next slide, please. Yeah, so this just starts by showing the state of the industry in terms of who's really making progress, who has scale, et cetera. You can see Netflix is a clear market leader. Disney Plus has made very significant gains in the 3 years that product's been live. Then you have Warner Brothers Discovery, which is, making more and more progress, but is still a relatively small player. Then you have Hulu, which is majority owned by Disney, and again, also a relatively small player, US only offering, but it's an important part of Disney's bundle, I should say. Next slide. So the first slide was subscribers. Obviously, subscribers is just one important part of the equation. The other important part is ARPUs, how much you're generating per customer. As you can see here, Netflix run rate revenues are north of $30 billion. Disney, excluding Hulu Live, which is the MVPD, is right around $15 billion. Then you have some other players in the industry that are quite a bit smaller, WBD and Paramount, and this doesn't include others like NBC Universal. So basically what you're seeing here is, you have some players with significant scale, you have others who are trying to get there. And, this is, in my mind, a very important metric in terms of who has the ability to invest and win in terms of a global game. Next slide. Yeah, this shows Netflix's ARPUs effectively, how much they generate per subscriber. It's funny that Netflix got painted with the brush of just being a sub story for a long time. Now we find ourselves in a position where, whereas many of their competitors have ARPUs in the $5, $6, $7 range, Netflix's global ARPUs with a much bigger international base than many of their competitors. A lot of them lean towards high income markets like the US. Despite that fact, Netflix's ARPUs are effectively 2 times higher, which explains the revenue gap shown in the previous chart. So it just really speaks to the strength of the position they've built, and obviously we'll try to defend and grow from over time. Next slide. Yeah, and this just shows the geographic growth for Netflix over the past 3 years. And as you can see, international's been a very significant driver of sub gains. And I wrote an article, I think it was earlier this year, that basically broke Netflix into 2 separate businesses, domestic and international, and showed how, in my mind, that's the proper way to view the business, how to think about the maturity of the different businesses, the profitability of the different businesses, et cetera. So, just as part of the bigger story, again, it's in my mind, it's a story of global scale and cementing your position as, a service provider or an SVOD or VOD provider, I should say, that is a really fundamental part of customers' viewing experiences. And we see that with the Nielsen data in the US, and we're getting more and more international data over time that shares a similar sentiment. So I believe that's going to be a pretty strong position for Netflix, and some of their competitors have a really tough hand as we look to the years ahead, which will likely mean either a shift in strategy with more licensing of content and less of, owned and operated D2C properties, or in some cases, it could mean inorganic, acquisitions or mergers. I went as quick as I could.
So I guess, how do you see this industry shaking out? Because I think that's the biggest question, right? Like if all, like with all these competitors, Paramount, Peacock, HBO Max, Hulu, Amazon Prime, Apple TV, right? There's just so many now. I feel like every new show comes out that I want to watch is on a different service, and it drives me insane. So I'm trying to now, as a consumer, I just try to rotate through the services, right? And there's a couple, I keep Disney Plus because there's a lot of stuff for the kids, but everything else I all right, I have Netflix now. Let me watch everything I want on Netflix for the next 4 or 5 months. And then I'm going to switch out and I want to go to HBO Max or wherever. But this can't keep up, right? Doesn't there have to be some consolidation at the end of this? Or how do you see this shaking out?
Yeah, I certainly think ongoing consolidation would be the most logical route from here. I think there's an open question whether or not the regulatory environment is such that deals can get done. We typically talk about this in terms of big tech. I've been watching Microsoft ATVI closely for a while. I think people thought it was early on, a deal that could get done. I've been fairly skeptical about that, and it's looking questionable now. So could Disney go out and buy Warner Brothers Discovery outside of issues like issues of owning 2 broadcasters and things like that? Just simply a deal of that size, could it get across the finish line? I think there's reason to be skeptical. At the same time, you can kind of get to a similar place if people decide that their D2C efforts have no feasible path to being successful, and they can just revert to a Sony type model where they license content. And again, I think this is really instructive in terms of Disney's approach over the past few years. And I think anybody would objectively say amongst the pure play streaming companies, not Amazon or Apple, Disney's clearly number two, has had the most success. And you look at the P&L that it's required for them to get to here, and it's been $10 billion in cumulative operating losses, right, in D2C, and they're not close to profitability yet. So it really speaks to how expensive this game is to play. And, if you're one of the smaller players, you really have to ask yourself, how likely is it that we're going to win over time, and how much is it going to cost, and how long will it take? And I think the answer for most of them looks about as bad as it's ever looked. And the market sees, and the market sees that, to be clear as well. These stock prices have not done well, and management's tone is, I think it's even shifted from the quarterly calls to some of the conference events that managers were at this week. I think it's moving that quickly at this point. So we'll see if that leads to action, but time will tell.
Anirban?
Well, I just think as what Alex said, like I think this industry is in flux, and like the other thing that is we forget is like this was supposed to solve a problem, but it's actually created another problem, right? We went from saying that cable is charging too much to having all this flexibility to now having all these different platforms, and everybody's charging you. Like if everybody's charging you $15, how many of them can you actually have, right? So this disaggregation is in a way really bad, and I just don't think that many of these platforms that exist today in the shape and form that they do can exist over the long term, because you can't continue fighting. I mean, there's a price point at which you can't get new users, and there is a price point at which you cannot, if you don't increase the price, you're not sustainable, right? And to produce new content, you need to potentially increase the price. What do you do? At some point, some of these things need to be gobbled up and be part of, maybe larger. They need to be part of Prime or something Prime equivalent to
Apple
be
TV, whatever, yeah,
or whatever, to be worthwhile. To be to just be sort of that zero cost center, or break even center, so that you can drive other things based on that. But that's I think the story has really shifted from eyeballs. It's just, Alex said, it's no longer just about eyeballs, right? It's really about those dollars that are coming in, whether it's via ads or not. And it's a question about free cash flow again, I think. So, yeah, I really am uncertain about Netflix.
Yeah, and I think, again, to your point, it's if it's a free cash flow story now. I mean, Disney has just so clearly shown, if you're talking about getting to real scale globally, it's not something you can do in 18 months. I mean, it's just simply, it's not feasible. Unless you were able to launch it at a very significant price point, which that is not feasible in terms of getting, 100 million incremental subs, whatever it may be. So the path to get from A to B, again, I think it's funny. This all started as, at the start of the year, this started as the Netflix kind of awakening. And now that we're closer to the end of the year, the story in my mind is actually completely flipped to, this is the awakening for everybody who's not Netflix, or, maybe Disney as well. But even Disney is, trading in terms of, hey, is D2C going to be profitable over time? So again, if Disney's being painted with that brush, if you're running Paramount, WBD, NBCU, that's just a very tough spot to be in.
Yeah. Absolutely. Peacock and whatnot else exists.
Yeah, I do.
Yeah, one thing you don't have to worry about on the disaggregation, there's not too many people paying for Peacock, so you don't have to include that in your total consumer bill.
Yeah, but I just give you my example, right? So like, I've not cut Netflix for that occasional show, and it's partly because, and I've got Amazon Prime largely because I want actually the Amazon Video. So it's that, and I've got Apple TV Plus because I just have everything Apple. So I've got Apple TV Plus as a bundle. It just, the delta cost for me was, but I'm just not in a position to subscribe to one more, because even after having 3 of them, it's just sometimes hard to find actually useful content to watch. So
well, you only have so much time, me too, right? Like that's the other thing. Like, right. I mean, a lot of this content sounds great. I just, I have like maybe an hour at most an hour and a half, like, at night when right before bed, like I can devote to watching a TV show. And as often as not, like I'll binge Seinfeld on Netflix as like any of these like new shows. I mean, time is like a real competitor, to all these businesses.
Absolutely.
Yeah, something
Yeah,
I've written about a lot. Just one final thing on the topic for me is, I've written about this a lot, this idea of relative competitive advantages. And it's funny to see when you go through a cycle, the really painful periods, obviously it doesn't, you're still susceptible to stock price declines and or business headwinds. But, cycles that are really tough, if you're in a strong relative competitive position, are potentially a very, very good thing for you, because they make life really, really difficult for your less well-equipped peers.
Since we were on this topic, I think this is maybe worthy of a sort of slight detour. But while we were on this podcast, Mr. Musk has tweeted something very interesting. How do you make a small fortune in social media? You start out with a large one.
Oh wow!
So that's the story. Anyways,
Yeah, isn't that a play on an old Buffett quote about the airline industry or something? I feel like there's
I think there's a play here. Play on something else.
Yeah.
But yeah, it's
so real quick, Alex. Let's end it on this. But Alex, if you had to make a guess or a prediction about who blinks first in this industry, like who goes back to like the Sony model, where they're just selling content to one of these other DTC providers, like who do you think that is? Is that Paramount? Is that Peacock?
I think Paramount. I mean, there's been speculation about them considering other routes. Their commentary up until very recently would lead me to believe that, even though they're very poorly positioned in my mind, that they were willing to just be stubborn, even if it wasn't the most sensible thing to do. I think some of the CFO's comments at this most recent call suggested a pretty clear change in how they're at least communicating about this, and it probably speaks to the severity of the problem. Again, a lot of this is simply tied to how bad do pay TV numbers get in the short term, because as things stand today, most of these businesses have generally speaking very significant cash generation from the linear side of the house, but that is going away, and it's following significant changes in engagement that we've been tracking for many years now. So to the extent that worsens significantly, to the extent people don't want to make decisions, they're eventually going to be forced to make decisions.
And it seems like, I mean, Netflix or somebody else would pay a lot of money for Yellowstone and all those spinoffs they have going on now, for certain.
Yeah, it could be an interesting structure to the deal. I think there's probably precedent in what 21st Century Fox did with Disney in terms of partitioning those assets. I think there might be something there that makes sense as opposed to an outright sale. So we'll see.
All right, excellent. Well, everyone, thank you for joining us. Again, joined by my co-lead advisor, Anirban Mahanti, and Alex Morris, the creator of the TSOH Investment Research Service. We can all be found on Twitter. Like I myself spend way too much time on that platform. So follow us on Twitter, check out our services. I'm Matthew Cochrane, at 7 Investing, where it is our mission to empower you to invest in your future. Have a great day.